Structure of stock market datasets. This lesson covers the structure of real stock market data you will use as a finance analyst. In finance and stock market work, understanding how data is organized is essential for real-world analysis. You will learn to recognize and manipulate different types of real market datasets. We will cover multiple real stock market data formats, their meanings, and common mistakes beginners make. By the end, you will confidently explore, reshape, and work with real financial data for analysis tasks. Running the cell now. We import pandas for working with tabular financial data. We import NumPy for calculations and portfolio simulations. We import Ifinance so we can access free, real stock market data. We import the warnings library to control visible warnings. We set Python to ignore warnings for a cleaner notebook experience. Running the cell now. Here, we set up the environment by importing essential libraries like pandas for data handling, NumPy for numerical operations, and Ifinance for fetching stock data. Although there's no visible output, this step is crucial. It prepares the tools needed to explore and manipulate real stock market datasets, aligning with our lesson's goal of working confidently with financial data structures. Practice. Try running this cell to confirm your imports work without errors. Understanding the structure of stock market data. Stock market data comes in many forms: daily prices, financial fundamentals, and trading signals. Some datasets have one row per company, some have one row per date and ticker. Common columns are date, ticker, open, close, volume, and sometimes financial ratios like P/E. Beginners often get confused by multi-index columns or reshaped, pivoted data frames. Learning to quickly interpret these structures is vital for analysis and modeling. Running the cell now. We define 5 well-known technology stock tickers for analysis. We download 1 year of open, high, low, close, and volume for all 5 tickers from Ifinance. We reshape the resulting data from Ifinance into long format, so each row is one date and ticker. We remove any extra axis name left over from the stacking operation. We print the shape of the resulting data frame to see how many rows and columns there are. We display the first 3 rows to examine the structure of the dataset. Running the cell now. This output shows a tidy stock market data frame with 1,255 rows and 7 columns, where each row corresponds to a specific date and ticker symbol combination. Notice the key columns, date, ticker, and the OHLCV price and volume data, clearly separated to facilitate time series analysis across multiple stocks. This reshaped structure transforms the original multi-index format into a flat table, making it easier to work with for further analysis or modeling. Challenge: how would you select only the Apple APL rows from this dataset? Data structure, long format, 1 row per ticker is date. Each record now shows date, ticker, open price, high, low, close, volume. This long format is perfect for time series analysis and Group B statistics. Example: to filter for just Apple, use OLCV, ticker =LAPPLE. Beginners sometimes expect each company to be a single column. Do not be fooled. Running the cell now. We filter the entire dataset to keep only rows where the ticker is Apple. We display the first 3 Apple records to confirm the filter worked. Running the cell now. This output shows the first 3 rows of the filtered data frame containing only Apple stock data, illustrating the long format where each row represents a single date and ticker. Notice the key columns like date, ticker, and OHLCV prices, which are essential for time series analysis. This reinforces how filtering by ticker extracts a subset ready for detailed Group B or trend analysis without confusion from other companies' data. Try change Apples to Tesla above. What changes in the output? We reshape the dataset so each row is one date and each ticker is a column. Only the close price is kept. We show the first 3 dates of this wide format to see how the tickers are now columns. Running the cell now. This output shows the wide format version of the data, where each ticker is now a separate column and each row corresponds to a date with closing prices. Notice the shape shifts from long to wide, making it easier to compare prices across tickers on the same date. This transformation helps when you want to perform time series analysis or visualize multiple stocks side by side, complementing the lesson's focus on understanding different data formats. Question: what is the difference in shape between long format and wide format data here? Example: stock prices, wide format. Next, let us look at a stock price dataset, 1 row per date, columns for each ticker. This format is ideal for rolling windows, correlations, or visualizing comparisons. Beware, if a dataset comes from Ifinance with multiple tickers, column names are sorted alphabetically. Running the cell now. We define the same 5 tickers for familiarity. We download 1 year of daily stock prices for all 5 using Ifinance. We keep only the close prices and reset the index for a flat, tidy format. We remove any leftover column name to keep the data frame clean. We print the shape, rows, columns to show data size. We inspect the first 3 rows to see date and ticker columns in this wide format. Running the cell now. This output shows a data frame with 251 rows and 6 columns, where each row represents a trading day over the past year, and columns include the date plus closing prices for 5 tickers. Notice the columns are alphabetically sorted, which aligns with the Ifinance behavior mentioned earlier. This wide format structure makes it easy to perform time series analysis or compare stock trends side by side. Practice: check that your output columns are in alphabetical ticker order. Why does this matter? We select the first row of the dataset, which represents the earliest trading day. We print the entire first row to see the date and adjusted close price for every stock that day. Running the cell now. Here we print the first row of the data frame, showing stock prices for multiple tickers on a single date. Notice the wide format with each ticker as a column, making it straightforward to compare values across stocks for that specific day. This confirms we have 1 row per date, setting us up for time-based analyses like rolling windows or comparisons. Think, why might you want this format for quick comparison of different stocks on the same date? We specify the GitHub URL for the S&P 500 company list. We load the data into a data frame to examine its structure. We print the shape to check how many companies are included. We display the first 3 companies to see columns like symbol, sector, headquarters, and more. Running the cell now. This S&P 500 dataset contains 503 rows and 8 columns, listing key company details like ticker symbol, sector, and founding date. Notice how the columns capture both categorical data, GICS sector, and dates, date added, which are useful for analyzing sector trends or company tenure. This initial glimpse helps us understand the dataset structure before moving on to tasks like filtering or merging with stock price data. Prompt: how many columns are there, and are any columns categorical, non-numeric? S&P 500 company list, 1 row per company. This dataset shows 1 row per company, not per date. Typical columns: ticker symbol, company name, sector, headquarter location, and more. Such lists are critical for sector analysis, universe filtering, or mapping tickers to industries. Running the cell now. We filter the S&P 500 for companies classified as information technology. We print the ticker and name of the first 3 technology companies. Running the cell now. This output shows the first 3 companies in the information technology sector from the S&P 500 dataset, each represented by their ticker symbol and company name. Notice how filtering the full list by sector narrows down the universe to just relevant tech firms, which is essential for focused analysis or industry-specific strategies. This step demonstrates how to isolate and inspect a subset of companies based on sector classification. Use a different sector value to explore another industry. We create a list of 10 major tickers to simulate a portfolio. We define a sector mapping for each ticker to classify them by industry. We complete the rest of the sector mapping for all tickers. We finish constructing the mapping so every stock is assigned a sector. We set the random seed to 42 so the generated portfolio is reproducible for everyone. We fetch 1 year of closing prices for all tickers using Ifinance. We start an empty list to store each simulated portfolio position. We loop through every ticker to record position data. We record the buy price from a year ago. We record the most recent price as the current price. We append a new record with ticker, random number of shares, real prices, and sector. We finish adding all positions to our list. We combine all portfolio positions into a data frame for analysis. We compute the percentage gain, or loss, of each position using real price data. We print the portfolio's shape to see the number of positions. We preview the first 3 positions to confirm structure. Running the cell now. The output shows a concise portfolio summary with 10 companies, 1 row per ticker, and 6 columns including shares held, buy and current prices, sector, and gain percentage. Notice the variation in gain_PCT across sectors, illustrating how this table helps track sector performance and individual stock returns over the year. This aligns with the lesson's goal of organizing a single row per company to facilitate sector analysis and portfolio evaluation. Practice: what happens to gain_PCT if you choose tickers with larger price changes? Portfolio data set, simulated positions using real prices. Here, each row is a different stock held in a portfolio, with real buy and current prices. Random share count simulator real investors' positions. Columns include ticker, shares, sector, purchase price, latest price, and percentage gain. This format helps analyze portfolio performance, risk, and sector exposures. The gain_PCT is computed using the real buy and end prices, not randomly made up. Running the cell now. We sort the portfolio by the gain_PCT column to find the biggest winner. We print this positions data to see which stock performed best this year. Running the cell now. This output identifies the single stock with the highest percentage gain in the portfolio, highlighting Google with a 94.71% return. Notice the key columns: a substantial share count, 19, the original purchase price, 181.04, and the current price, 352.51, reflecting nearly doubling in value. This step demonstrates how sorting helps pinpoint top performers, essential for assessing portfolio winners and sector contributions. Prompt: how can knowing your top performer help you adjust your investment strategy? We define a diverse list of 12 large-cap tickers. We start an empty list to collect each firm's information. We loop through the tickers to fetch real company financials. We pull a dictionary of company info from Ifinance for each ticker. We record each company's ticker, sector, and several fundamentals into our list. We save the ticker symbol. We save the sector field. We record actual market capitalization. We fetch trailing P/E ratio from Yahoo Finance. We record trailing earnings per share, EPS, from Yahoo. We add profit margin as reported by Yahoo. We fetch debt-to-equity ratio, may be missing for some tickers. We finish the record for this company. We combine all records into a data frame to analyze together. We print the shape to check the number of companies. We preview the first 3 companies to see both numerical and categorical columns. Running the cell now. This output shows a data frame with 12 rows and 7 columns, each row representing a key stock with its sector and fundamental metrics like market cap, P/E ratio, EPS, profit margin, and debt-to-equity ratio. Notice the variety in sectors and financial ratios, which provides essential context for evaluating portfolio quality beyond just prices. This code segment demonstrates how to enrich a portfolio dataset with real fundamental data, enabling deeper analysis of risk and growth potential. Tip: financial ratios may be missing, NaN, for some firms depending on reporting that happens in real data. Fundamentals dataset, company-level data. Here, each row is one company and columns store important financial benchmarks. Typical fields: market cap, trailing PE, EPS, profit margin, debt and equity. Use such data for valuation, risk, and screening filters in finance. Beginners often forget real-world data may be missing values. Running the cell now. We download 2 years of SPY ETF daily prices for analysis. We keep only the closing price and trading volume and reset the index. We rename the columns to simple labels: date, price, and volume. We calculate daily returns as % change in price, real returns, not backfilled. We drop the first row, as its return is undefined, and reset the row index. We print the shape to check the total number of days and columns. We display the first 3 trading days to see date, price, return, and volume. Running the cell now. This output shows the transformed SPY dataset with 499 daily records, each having the date, adjusted closing price, trading volume, and calculated daily returns as a percentage. Notice the daily _return column capturing % price changes, which is key for understanding short-term market movements and volatility. This step teaches how to prepare and augment real-world financial time series data for further analysis. Explore: what typical financial analyses could you perform with column daily _return? Returns to time series data, row per date. Common for price and returns data, each record is a specific trading date. Key columns: date, price, typically close, daily return, %, and often volume. Such time series are critical for backtesting and volatility analysis. Running the cell now. We fetch 1 year of daily Apple prices for signal generation. We keep closing price and volume for each date. We rename columns for clarity. We compute the 20-day simple moving average, SMA 20, of the close price. We compute the 50-day moving average, SMA 50. We assign a trading signal, 1 if SMA 20 is above SMA 50, buy, -1 otherwise, sell. We print the data frame shape to see total rows and columns. We preview the last 3 rows to check our signals for recent days. Running the cell now. The output shows a data frame with 251 rows, each representing a trading day over the past year, including key columns like date, closing price, volume, and 2 moving averages, 20-day and 50-day. Notice that the moving averages smooth price data, and the signal column indicates whether the short-term trend, SMA 20, is above the long-term trend, SMA 50, which is currently signaling 1 or a potential buy. This structure is essential for time series analysis, helping to identify trend changes over time. Challenge: can you find periods where the trading signal switches? Advanced error handling with real datasets. Real financial datasets may have missing prices, nulls, or bad types. Always check for NaN values when performing aggregations or calculations. Watch for sudden changes in column names or order, especially after downloading new data. Running the cell now. We check how many missing NaN entries are in each column of the signal data frame. We print the count of nulls to identify columns that may need cleaning. Running the cell now. This output reveals the count of missing values in each column of the dataset, showing that SMA 20 and SMA 50 contain 19 and 49 NaNs respectively, while other columns have none. This highlights the importance of checking for NaNs before calculations, as these missing values in moving averages could skew analyses or signals if not handled properly. Noticing which columns have gaps guides us in applying targeted error handling or data cleaning steps in our workflow. Good practice: inspect missing data before running calculations on signals or returns. We create a new data frame by dropping all rows that have any missing fields. We print the shape to confirm fewer rows after cleaning. We show the first 2 rows of the clean dataset. Running the cell now. The output shows that after dropping rows with missing values, the dataset contains 202 entries and 6 columns, confirming successful cleaning of NANs. The first 2 rows display key financial indicators like closing price, volume, and moving averages, illustrating the clean, consistent structure needed for reliable analyses. This reinforces the lesson's focus on handling missing data to ensure accurate calculations in real-world financial datasets. Reflection: how might dropping NANs affect backtests or historical analysis? Best practices for working with stock market datasets. Always examine the ROE column structure before any analysis. Use info, head, and describe often to preview data types and ranges. Set np.random.seed 42 for any simulated portfolio positions to ensure reproducibility. Document column meanings if processing many datasets. Never guess ticker order after Ifinance downloads, always verify. Running the cell now. We call info on the clean data frame to check column types and missing values. We use describe to get summary statistics for the signal data frame. Running the cell now. Here, the .info output confirms that clean_df has 202 rows and 6 well-typed columns without missing values, which is crucial before deeper analysis to avoid surprises. Meanwhile, the .describe summary of signal_df gives statistical insights on columns like close, volume, and moving averages, showing a typical price range and volume spread. This helps validate data consistency and understand feature distributions early on. Both steps align with best practices. Verifying data structure and basic stats ensures reliable and reproducible analysis downstream. Tip: these commands help spot unexpected integer, float, or string types before analytics. Now let us solve a small investment question: which sector had the highest average portfolio return? We group the portfolio data frame by sector and compute the mean percentage gain for each sector. We print the result to compare average returns by industry group. Running the cell now. This output shows the average percentage gain grouped by sector, revealing key variations like a strong health sector gain, 68.48%, and a notable loss in media, -41.49%. By verifying these grouped summary statistics, the code demonstrates how to interpret sector-level trends and validate your data's structure before deeper analysis, an essential step in best practices for stock market datasets. How would this help a real investor or a financial analyst decide future allocations? Watch more Jupiter Finance tutorials on YouTube. For more learning, review this notebook regularly to reinforce how financial data is structured. Explore real datasets on Yahoo Finance or GitHub, and practice inspecting their columns and row layouts. Check out additional guides on the official Pandas documentation or YouTube for deeper skills. Running the cell now. Subscribe to our YouTube channel for more practical stock market tutorials.